Turn off the television. Mute the pundits on CNBC who are trying to tell you that today is just another standard economic update. If you're listening to this on January 28th, you are witnessing the most dangerous moment in modern financial history. The Federal Reserve has just concluded its first FOMC meeting of 2026. And while the algorithms are busy analyzing the dot plot, and the stock market is gyrating wildly based on a fraction of a percentage point, the real story is being buried. You are being distracted by the noise, so you do not hear the sound of the foundation cracking. Jerome Powell's speech at 2:30 p.m. today was not a policy update. It was a confession. For the last 2 years, they have promised you a soft landing. They told you they could raise interest rates to fight inflation without breaking the economy. They lied. Today, the Federal Reserve is officially cornered. They are staring at a mathematical impossibility. If they keep interest rates high to fight the inflation that is eating your paycheck, the banking system implodes. We have already seen the cracks with the regional banks. Now the contagion is moving to the too-big-to-fail institutions. But if they cut rates, if they pivot like Wall Street is begging them to, then inflation will roar back with a vengeance, destroying the value of the dollar in your pocket. They have to choose. Save the banks or save the currency. They cannot save both. What you need to understand about today's announcement is that the number doesn't matter. Whether they held steady or cut by 25 basis points is irrelevant. The signal is in the silence. Look at the balance sheet. Look at the reverse repo facility. The liquidity that was holding the system together is drying up. The Fed is desperately trying to engineer a controlled demolition of the middle class, hoping you won't notice that your purchasing power is evaporating until it is too late. They are using complex language, quantitative tightening, neutral rate lagging indicators, to mask a simple, terrifying reality. The United States government is bankrupt, and the Federal Reserve is the only entity keeping the checks from bouncing. When you hear the chairman speak today, do not listen to his words. Watch his hands. Watch what they do in the overnight lending markets. They are preparing for a credit event. They know that the commercial real estate sector is collapsing. They know that the consumer has maxed out their credit cards. Today's meeting is the final warning bell. They are telling you in code that the Fed put is gone. The safety net has been removed. You are walking on a tightrope over a burning city, and the people who built the rope are currently setting it on fire. This is not about market volatility. This is about the systemic failure of the fiat standard. The trap has been sprung, and if you're still holding on to the belief that the Fed is in control, you are the prey they're hunting. Let S strip away the press conference polish and look at the forensic reality of the crime scene. The media is debating whether the Federal Reserve is hawkish or dovish, but this is a false dichotomy designed to keep you looking at the wrong hand. The real agenda of today's meeting had nothing to do with the price of milk or the unemployment rate. It was entirely about managing the systemic insolvency of the United States banking sector. You need to understand the mechanics of the trap. For over a decade, the Federal Reserve kept interest rates at near zero, encouraging every bank in America to load up on long-term U.S. Treasury bonds. These banks were told that U.S. debt was risk-free. They bought trillions of dollars worth of it. But when the Fed hiked rates to fight inflation, the value of those bonds collapsed. This is simple math, but the implications are catastrophic. When interest rates go up, bond prices go down. The banks are currently sitting on over $600 billion in unrealized losses. They are technically bankrupt. The only reason they haven't collapsed yet is because the Fed allowed them to hide these losses off the books or mark to maturity. But today's decision confirms that the pressure is not going away. By keeping rates elevated, or even by simply maintaining the current higher for longer stance, the Fed is effectively holding the banking system underwater. They know the victim is drowning. They're just trying to calculate how long they can hold the head down before the heart stops. This is the liquidity crisis that no one is talking about. The reverse repo facility, the emergency savings account that the financial system has been using to stay liquid, is draining rapidly. Once that tank hits zero, there is no more cushion. We are moving from a world of abundant reserves to a world of scarce reserves overnight. And when reserves become scarce in a highly leveraged system, things break. We saw it in 2019 when the repo market seized up. We saw it in 2023 with Silicon Valley Bank. But the next break won't be a regional outlier. It will be a systemic heart attack. The Fed knows this. That is why their language today was so careful, so scripted. They are terrified of triggering a run on the shadow banking system. The real agenda is not to engineer a soft landing for you. It is to engineer a bailout for the sovereign debt market. The U.S. government needs to roll over trillions of dollars in debt this year. They need buyers. If the Fed cuts rates too soon, the dollar crashes and foreign buyers flee. If they keep rates high, the domestic banks collapse. They are trapped in a doom loop. Today's meeting was an exercise in buying time. They are trying to keep the illusion of stability alive for just one more month, one more quarter, hoping that something, maybe a war, Maybe a new pandemic will give them the excuse they need to turn the money printer back on without admitting defeat. You must stop viewing the Federal Reserve as a competent arbiter of the economy and start viewing them as the triage team for a dying currency. Every policy decision they make now is simply choosing how the patient dies, by fire, hyperinflation, or by ice, deflationary depression. The banking system is already dead. It just hasn't stopped moving yet because of the artificial stimulus pumping through its veins. Today, Jerome Powell didn't fix the problem. He just confirmed that the cancer is terminal. And while Wall Street celebrates the certainty of the decision, you should be preparing for the inevitable chaos that follows when a zombie banking system finally runs out of brains to eat. Now we descend into the darkest part of the rabbit hole. You must ask yourself, why would the Federal Reserve knowingly drive the banking system off a cliff? Why would they risk a Great Depression 2.0? The answer is terrifyingly simple. They are not trying to save the current system. They are preparing to replace it. Today's FOMC meeting, with its calculated ambiguity and refusal to pivot, is the demolition phase of the old economy to make way for the new one, the central bank digital currency. The FedNow system, which they rolled out quietly while you were distracted by inflation headlines, was not an upgrade. It was the foundation for a digital prison. Think about the problem the Fed faces. Their traditional tools, interest rates and balance sheet maneuvers, are blunt instruments. When they raise rates to stop you from spending, they crush the entire economy. It is like using a sledgehammer to kill a mosquito. They have lost control of the velocity of money. They can print trillions, but they cannot force you to spend it where they want or stop you from hoarding it when they need liquidity. The current system offers you too much freedom. You can withdraw cash. You can trade privately. You can opt out. This is the bug they are trying to fix. The solution they are engineering is a currency that is programmable, traceable, and entirely centralized. By keeping interest rates high and stressing the regional banking sector, the Fed is forcing a massive consolidation. They want the small banks to fail. They want the mid-sized lenders to be absorbed by the too-big-to-fail giants like JP Morgan and Chase. Why? Because it is much easier to implement a CBDC through 4 or 5 megabanks than through 4,000 community banks. We are watching the purposeful destruction of decentralized banking. Every time a bank fails and is bailed out, the condition for that bailout is closer integration with the Federal Reserve's digital ledger. Today's meeting was just another turn of the screw, squeezing the life out of the independent financial sector to clear the board for FedCoin. This is not speculation. It is written in their own white papers. They call it the Regulated Liability Network. We call it the end of private property. In a CBDC world, the Federal Reserve doesn't just set the interest rate for the economy, they set the interest rate for you. If inflation is high, they can impose a negative interest rate on your personal wallet, forcing your savings to decay by 2% a month if you don't spend them. If the economy is crashing and they need stimulus, they can drop digital dollars into your account that expire in 30 days. Today's volatility is just the smoke. The fire is the transition to a system where money is no longer a store of value, but a system of control. They are creating a problem, a liquidity crisis, and a banking collapse, so they can offer you the solution. When the ATMs stop working, when the credit cards are declined because the banks are insolvent, the Fed will step in as the hero. They will say, "Don't worry, download this app, open a direct account with the Fed, and your funds are safe." It will sound like a rescue. It will feel like safety. But the moment you accept that digital lifeline, you're stepping into a panopticon where every transaction is monitored, every purchase is judged. And your ability to participate in the economy is a privilege that can be revoked at the push of a button. The Fed shock is not about rates. It is about herding you into the digital pen. There is a way out. There's an escape hatch that the Federal Reserve cannot close, a ledger they cannot edit, and a vault they cannot lock. While the world is distracted by the theater of the FOMC meeting, debating whether rates will go up, down, or sideways, you have the opportunity to make the only move that actually matters. You can exit the casino entirely. The solution to a rigged game is not to play it better. It is to stop playing. It is to take your wealth out of the digital system that is being weaponized against you and convert it into the only asset that has survived every banking collapse, every hyperinflation, and every empire failure in human history: physical silver. You need to stop looking at the spot price of silver on your screen today. That number is a lie. It is a derivative price set by high-frequency trading algorithms and paper contracts on the COMEX, designed specifically to discourage you from owning the real thing. When the Fed keeps rates high, they strengthen the dollar artificially, and they smash the paper price of gold and silver. Do not be demoralized by this. Be grateful for it. They are subsidizing your lifeboat. They are artificially suppressing the cost of the very asset that will save you, giving you one final window to accumulate real wealth at a discount before the paper system disintegrates. Think about the properties of a physical silver coin. It has no counterparty risk. It does not rely on a bank to be solvent. It does not rely on the internet to be online. It does not require a password, a fingerprint, or a facial scan to access. It is the antithesis of the central bank digital currency. In a world where every transaction is tracked and every dollar is a liability of a bankrupt state, a silver eagle or a silver maple leaf is a battery of pure sovereign energy. It is anonymous, it is private, it is yours. When you hold it, you become your own central bank. You declare independence from the madness of Jerome Powell and the insolvent Treasury. The Fed shock we witnessed today is the signal that the end game has begun. Whether they crash the system now by holding rates high or hyperinflate it later by pivoting, the destination is the same, the destruction of the dollar and the implementation of the CBDC. If you stay in cash, you lose. If you stay in the stock market, you're trapped in a burning building. But if you move into physical metal, you are building an ark. You are preserving the purchasing power of your labor in a form that cannot be inflated away. Do not wait for the official announcement. Do not wait for the banks to declare a bank holiday. By the time the panic starts, the physical metal will be gone, the premiums will skyrocket, and the inventory will vanish. You have to move when it feels uncomfortable. You have to buy when the price is boring. Today, the Federal Reserve proved that they are trapped. They have no way out, but you do. Take the warning. Drain your digital accounts of everything you can afford to lose and secure your future with the only money that is immortal.